Mike is a distinguished visiting fellow at the Hoover Institution. He's the Board of Governors Professor of Economics at Rutgers and the director of the Center for Monetary and Financial History there too. His paper is joint with Mickey Levy, who's chief economist for Americas and Asia at Berenberg Capital Markets. Both are frequent and enthusiastic contributors to our conferences on monetary policy. We appreciate it greatly and appreciate that they're here today, very much so. The title of the paper, and we've been discussing it a little bit as you've been in the waiting room, sorry about that, is Do Enlarged Fiscal Deficits Cause Inflation, the historical record. And I might add, it is a Hoover Economics Working Paper, number 20124, if you want to look at some of the details. We will have some time for questions and answers, so you can raise your mechanical hand or signal on the chat function, and we'll try to get into that. John Cochrane will be helping me look through the names and asking questions. So as you know, this meeting is being recorded, and I think Michael and Mickey will be using some slides. I'm not sure how the tag team match will work, but I'm looking forward to it. So welcome.
Okay, thanks a lot. Okay, so the way we're going to do this is I'm going to talk for a while and tell some of the old stories, and then Mickey is going to take over and he's going to focus on the US experience starting in the 60s to the present. Okay. So what we're doing here is just an overview is that the current pandemic and policy responses of massive fiscal and monetary expansion we believe has a lot of resonance from history. So what we do is we assess historical and also modern episodes, and we find there's some similar themes of deficit financing associated with inflation. And this link between fiscal deficits and inflation is most apparent and pronounced in wartime, and we'll be spending a lot of time on some of these episodes, but it also occurs in peacetime, and we'll discuss some of those episodes. Sort of moving forward to the recent past, the subdued inflation in the decade after the great financial crisis, despite the fact that we had high deficits and monetary ease, seems to be more of an exception rather than the rule. And just to give you something to look forward to, go back a sec, just to have something to look forward to, we're going to consider at the end whether the current run-up in fiscal expenditures and monetary expansion might lead to future inflation. So, okay. So let's go. Okay, now we can go. Okay, so we have two figures here. They're big sweeps of history. And in fact, you can go to figure one right now. Next, yeah. So what figure one shows you is the long run record of the debt to GDP ratio for the UK and the US going back 2 centuries. We didn't show the fiscal deficit to GDP ratio, but the patterns are not that different. And what you can see is that in both countries, the debt ratio spikes during major wars and then it recedes. And if you look at for the US, that recent run-up we have at the very end there is an exception to the historic pattern. And that largely reflects the income support programs in the US, entitlement spending, et cetera. And we'll talk about that later. So then we go to figure two for the UK. Okay, that's fine. So the UK is quite similar, but it doesn't have quite the run up in debt right now. Now we go to inflation. This goes back a long time, 2.5 centuries for the US and 4 centuries for the UK almost. And what you see is that inflation tends to spike during wars and recedes during peacetime. And the primary exception is the Great Inflation of 1965 to 1980. So before I get into the stories, so go to the next slide, please. Yeah. Before I get into the stories, I'm going to give some very, a very brief, mention some theoretical perspectives. It's very brief, very truncated, and I hope that John Cochrane doesn't tell me that I'm totally wrong on the fiscal stuff. But anyway, so there were two theories that dominated the literature in the 20th century. The early Keynesian approach, which was dominant in the 50s and 60s and even before. And the simplest idea is it's that excess aggregate demand leads to inflation, but it depends on the slope of the aggregate supply curve. Later it becomes the Phillips curve. And so the simplest story was this sort of L-shaped supply curve where you had aggregate demand would be shifting to the right and all the effect would be on output, and then it would hit full employment and it would rise and would all go into inflation. And so in this theory, fiscal expansion is inflationary, and the early theories also didn't think monetary policy had any effect at all. The idea was that the LM curve was horizontal, or we were in a liquidity trap. So opposed to this was Milton Friedman and his new quantity theory of money, modern quantity theory of money, in his book in 1956. And basically, he said that in the modern quantity theory, that changes in the money supply lead to changes in nominal income. Initially, their effects are felt on real GDP and then on prices, that you need sustained money growth to get sustained inflation. And this will be amplified by inflationary expectations leading to a rise in velocity. And in Friedman's view, fiscal policy, unless it was money finance, had no effect. So that was these two views that dominated a good chunk of the post-war period anyway. And then I'm going to mention briefly two modern approaches, which in a sense are in some respects follow through from the earlier approaches. The first is the unpleasant monetarist arithmetic story from Sargent and Wallace. And here they have rational expectations and perfect foresight. And in their framework, bond finance fiscal deficits will be accommodated by inflationary increases in high-powered money to satisfy the government's long-run consolidated balance sheet. And the second theory is the fiscal theory of the price level associated with John Cochrane, Eric Leeper, who's here, and Chris Sims. And in a sense, it says that the bond finance fiscal deficits that are not fully backed by future taxes will lead to fiscal dominance. And what happens is that economic agents are going to perceive the increase in nominal debt to be an increase in real wealth, and that'll lead to a wealth effect that will increase consumption, expenditures, and raise prices. That's going to reduce the real value of the national debt and restore fiscal equilibrium. So in the Sargent and Wallace framework, fiscal deficits are inflationary because they lead to monetary expansion, whereas in the fiscal theory of the price level, fiscal deficits are inflationary by themselves. So, yeah, next slide. So what we do is we tell some stories from history. I'm going to talk about wars and then talk about peace. And so I'm going to look at it sort of by centuries. And I'm giving a very truncated story, but it's in more detail in the paper. So I picked three episodes that I really thought were interesting. Sweden in the middle of the 18th century. Now the Riksbank is the first modern central bank. It goes back to the 1667, I think. And what happened was that it was pressured by the Swedish authorities to finance the fiscal deficit during a war with Russia in 1745, and then another one, the 7 Years' War. So they issued paper money, and that led to a doubling of the price level. Now, they were on the gold standard before this, specie standard. They went back after a few years. So this is a pattern we see later, but I brought them up because I think they were the first sort of episode of what we kind of call modern inflation and fiscally dominated inflation. The second episode is the American Revolutionary War. I cite my colleague Hugh Rockoff, who I think is on this webinar, who did a lot of research on this and helped me with it. So the Congress was unable to raise taxes or issue bonds for reasons that are not too hard to understand. The war was fought about taxes and they didn't have any credibility to borrow. So the Congress financed 3/4 of government spending by issuing these paper notes called Continentals. And this was an early example of the inflation tax. Now, these Continentals were derived from the colonial bills of credit that were issued by the colonies. And these were tax warrants or tax anticipation warrants. But unlike some of the colonial bills, the Continentals were not backed by future taxes. They started off and said they would, but then they didn't. Okay. The third 18th century case is the French Revolution. Again, my colleague Eugene Wright's written a lot about that. And the revolutionaries financed the wars that they got into with their European allies by issuing assignats. These were notes backed by the value of the church properties that they seized. And they were supposed to be redeemed, but they weren't. And they kept issuing more of them. And then they had a hyperinflation in 1795 and a total monetary collapse, which was ended when Napoleon took over and restored the gold standard. Okay, the next slide, please. Yeah. So then I go to the 19th century, and I'm going to talk about two wars, big ones. The Napoleonic Wars from 1797 to 1815, and this is based on work that I did with Eugene White a long time ago. So the British Treasury issued consols to finance the war. They issued these infinitely dated bonds, which led to the run-up of debt that we saw in Figure 1. Okay. And they followed a tax smoothing policy, that formula that had been developed by the British in the 18th century. But the scale of the war led the government to request the Bank of England to accommodate the government's short-term treasury bills. And that ended up squeezing the Bank of England. So they suspended convertibility. And then Britain went on a fiat money standard. They suspended the gold standard. And this is an early example of the gold standard as a contingent rule, something I talked about with Finn Kidlin in a paper a long time ago. And the idea was under the gold standard, you maintain convertibility to gold, a fixed price of gold. But if a big emergency comes along, like a war, then you suspend it. You can run large fiscal deficits, because the gold standard assumes you're going to run a balanced budget and you're going to keep monetary policy is not going to be used. You're going to have stable money. So in the war, you can temporarily leave the war, you can issue debt, and you can print paper money. And this is what the Bank of England did. And the note issue led to 10% inflation. The seniorage that was created financed about 10% of the fiscal deficit. And what happened is, when the war ended, it went back to the rule. It ran fiscal deficits, fiscal surpluses after the war. It retired its notes and went back to the specie standard. It was associated with a recession, but recessions didn't lead to the kinds of political backlash they did do today. The second case is the U.S. Civil War from 1861 to 65. And here again, the federal government issued bonds in 1861, which were not sufficient to meet fiscal needs. So the federal government in 1862, January, suspended specie convertibility and issued greenbacks, and these were paper notes. And that led to a 25% per year rate of inflation. After the war, the federal government did what the British did in this Napoleonic Wars. They ran fiscal surpluses and they retired the greenbacks, resuming convertibility in 1878. That didn't happen that smoothly. There was this period from 1865 to 1878 where there was a big debate between the forces of hard money and soft money, where the hard money forces eventually won. Friedman and Schwartz talk about this in great detail. If we look at the Confederacy, they financed 60% of the war with fiat money, and that led to hyperinflation. Okay, so next slide. So this is now our 20th century. So in World War I, the unprecedented scale of the war led to massive fiscal expansion by the European belligerents. The debt ratio in the UK went up to 140%, France 200%. And central banks acted as engines of inflation. They pegged short-term interest rates at low levels to facilitate government finance. UK inflation was 25% per year. For the US, the shorter involvement, the debt ratio was 35%, inflation was 12% per year. And after the war, gold convertibility was restored by monetary and fiscal retrenchment. And just to say a couple of things about what happened afterwards. So after the war, both the US and the UK followed a very tight monetary policy. This led to a recession, 1920-21. The US had never left the gold standard. The British went back in 1925 at an overvalued parity. The other countries had much higher inflation and much bigger debt overhangs. And they had a lot of difficulty in getting back to the gold standard. And they did so with very, very great devaluations. And of course, the Central Powers had hyperinflations. Next slide, please. Okay, so World War II is financed like World War I. The fiscal, the G over Y rises to 32%, debt ratio to 120%. It's financed by taxes, bonds, and seniorage. The Fed accommodated the Treasury, lost its independence de facto, pegged short-term interest rates of 3/8%, and long-term rates of 2.5%. Inflation wasn't that high; it was 4.5, but we had pretty stringent wage price controls. And then after the war, the fear of repeating the post-World War I deflation led the Fed to maintain their rates peg and follow expansionary monetary policy, leading to an over 11% inflation from 1945 to 48. The Fed got its independence restored with the Treasury Accord in 1951, and the pegs ended. The debt ratio, which ran up to the levels we have today, was reduced by 1974 through a process of inflation, growth, fiscal surpluses, and financial repression. Next slide, please. Yeah. Okay, so I'm going to talk. I know I'm taking a lot of time. I'm going to take another 5 minutes or so, maybe 10, 5 minutes on peacetime episodes. And I'm talking about three of them. France in the 1920s and the US in the 1930s. And when we talk about the 20s, everyone always looks at the losers of World War I, Germany, Austria, Hungary, which had fiscal disasters and hyperinflation. So I'm not going to do that. I'm going to look at France, which I know something about. It was a winner. It was in better political shape than the Central Powers. They had a fiscal stalemate between the left and the right, and high inflation for 7 years. And it was, I think, a classic case of fiscal dominance. And the political impasse was about how to finance the recovery. And I'm not going into the politics of it, but what happened was the Bank of France ended up being pressured to absorb the short-term treasury bills of the government, which made the inflation even worse. And the way they restored fiscal balance was by political compromise by Raymond Poincaré in 1926, raising taxes, cutting spending, and borrowing dollars from JP Morgan to go back to the gold standard at an 80% devaluation. The next case, the US, this was talked about by Eric Leeper last semester, but Friedman and Schwartz explained the recovery beginning in 1933 from the Great Contraction by the banking holiday in March. Roosevelt devaluing the dollar by 60% and leading to an increase in the monetary gold stock and raising prices. So Jacobson, Leeper, and Preston, they argued, based on the fiscal theory, that the inflation in the 30s is best explained by Roosevelt's unexpected off-regular budget issue of unbacked fiscal expenditures. Some of the big famous New Deal policies were done this way, along with a passive Fed. And so the increased nominal gross debt led to an increase in consumption and rising prices. Okay, next slide, please. Okay, so this is my last example, and this is going to segue into Mickey's talk. So we're talking about the Great Inflation, and I've been working on a project with some colleagues at the Bank of England on what happened in the UK. So the UK inflation experience was among the worst in the G10. It was only surpassed by Italy. And it was characterized by fiscal dominance. The public sector borrowing requirement, the fiscal deficit, was accommodated by the Bank of England, which was not independent. And you can see this in figures 3 and 4. So Mickey, you can go to figures 3 and 4. Yeah, and we can keep those on. So the Treasury followed expansionary fiscal policy to raise economic growth in the 1960s. And this was called go policy. And that led to inflation. And the Bank of England accommodated the fiscal expansion. The policies were justified by the Keynesian Phillips curve view, and also by a view posed by Nicholas Caldor, who was a Cambridge economist and a very influential guy back then, that expansionary monetary and fiscal policy could raise trend economic growth. And so they believed in this sort of go for growth theory. And what happened is expansionary monetary fiscal policy they'd have this expansion, they'd have inflation, but they were on the Bretton Woods system. So they'd hit the Bretton Woods constraint. They would have a current account, they'd have a balance of payments crisis. And then what would happen is they get bailed out, rescued by the IMF, G10, the US, and then they would follow a stop policy because of the conditionality. So they'd have to cut back. And then once they got back and once the current account deficit improved, then they started again. So they went through 4 phases of this stop-go policy. And then when Britain left the Bretton Woods system in 1972, there's no constraint on the go policy. And then they just get monetary and fiscal policy going into overdrive, and you get this famous barber boom, and inflation is plus 25, close to 25% by the mid 70s. And it ends with a currency crisis and an exchange rate crisis, and IMF steps in, rescues it with conditionality, and in 1976, and that segues into the reforms that came at the end of the 70s with Thatcher. One other thing I forgot to mention was in the 60s, like the US, inflation ratcheted up as inflationary expectations increased. And also they imposed wage price controls on the belief that inflation was cost push. So there were a lot of similarities with the US. So I'll turn this over now to Mickey.
Okay, thanks, Mike. Well, the U.S. Great Inflation during the 1965 to 80 is a very interesting and really a painful story, with some interesting parallels to maybe where we are now, or at least the risks where we are now. So you have to keep in mind inflation and inflationary expectations were close to flat in the 10 years leading up to 1965. And then for a decade and a half, inflation rose and inflationary expectations rose, and they became embedded. And they came down a bit, but they kept ratcheting up. And beginning in 1966, there was a surge in government spending, Great Society programs plus Vietnam War spending, and an accommodative monetary policy. And this combined to generate excess demand. So back then you had William McChesney Martin led Fed that submitted to LBJ's demands to finance, his Great Society programs and Vietnam War. And I would note, if you look at spending during those couple of years, it ratcheted up to double digit in 1965, 1966, 67, 1968, spending rose like almost 50%. So you had a clear case of fiscal dominance with clear monetary accommodation. Now, the dominant theme that drove policy deliberations was the Phillips curve, and an absolute dominant priority on lowering the unemployment rate. So with the notion of the policymakers explicitly tried to buy their way down the Phillips curve. Enter Fed Chair Burns in February 1970. He was under the thumb of President Nixon, and he had a very eclectic view of inflation. He believed in cost push inflation, the role of labor unions. He favored income policies and wage and price controls. He favored ending the gold standard. And so the 1970s inflation expectations were already embedded. We had negative supply shocks from the oil price increases that the Fed accommodated. And basically there were temporary tentative efforts to constrain inflation that were overwhelmed by concerns about its impacts on the unemployment rate. And, remember in I think it was 1978, Burns gave a paper on the anguish of central banking. So the 1970s, once again, some very interesting stories about it, but you had rising inflation, rising embedded inflationary expectations, and a lack of central bank credibility that culminated in a currency crisis. Now, Mike mentioned a few, but let's consider the similarities between the US and the UK during that period. They both had flawed analytical frameworks for the deliberations of macroeconomic policies. Heavy reliance on the Phillips curve, perceptions of cost push and demand pull, sources of inflation, complete ignorance on monetary policy and its role in the inflation process. Also, heavy reliance on regulations, including income policies and price controls. And overriding this, once again, with the Phillips curve, was the highest priority on reducing the unemployment rate, and that took priority over concerns about inflation. So it was kind of a who could outdo each other, the UK's go for growth policy versus the US wage and price controls. So what you had is, and I think this is critically important, particularly to where we've been the last 10 years. In the UK, you had a sharp acceleration in nominal GDP above 20%. In the US, nominal GDP growth exceeded 10% per year for 4 years straight at the end of the 1970s, while the incomes policies and regulations constrained demand. So you had this case of excess demand relative to productive capacity. So you had prices, inflation go up and wages go up. And the result was very poor economic performance, loss of credibility. Governments generate, a currency crisis, and then, of course, like the UK, this elicited a policy regime shift, and in the US, it was Volcker, Reagan that imposed sound monetary policy and economic medicine, and the adjustment to lower inflation, of course, involved recession, and then the Great Moderation followed for a sustained period. Now, fast forward to the financial crisis of 2008-9 and its aftermath. And so, as we all know, it was a debt-financed housing bubble, and the short-term funding dysfunction evolved into severe financial crisis. And without going into any detail, the Fed was very slow to respond during the buildup of the problems, and then moved aggressively in late 2008 with its QE1. So when we think about the government's response to the financial crisis, the bailouts, the deficit spending, the monetary ease, it involved a joint venture of the Congress, the Treasury, and the Fed. And if we look at back then in January 2009, the American Recovery and Reinvestment Act, it involved $780 billion in spending, or about 4.9% of GDP. TARP actual outlays were about 410 billion. And of course, keep in mind that TARP money went straight into a banking system, and banks did not increase lending. Of course, they needed to recapitalize, so that TARP money, never worked its way into the economy. And you had a crippled banking system that was really constrained. So the Fed was at the zero lower bound. Yes.
Mickey, let me interrupt. I think Mike Boskin has a question before you go to the next slide. Michael?
Yes.
Yeah, I think this is great. I've had several discussions with your co-author on this subject, but it seems to me that a fuller story would also discuss both disinflations and fiscal consolidations and their success and failures. It seems like if you want a kind of a coherent full theory rather than a partial one, that would be something that you want to focus on as well, maybe in your next paper. That's just a general point, whether that's, expanding Sargent-esque analysis away from the four big inflations, and there's been a lot of research on fiscal consolidation in the OECD in the last several decades.
If I could just follow on to that, which is a great suggestion. What went right in the 1980s, which was both monetary and fiscal reforms, the inflation targets were both monetary and fiscal. So the successes as well as the failures are good.
I think those are very good points. I mean, I don't want to go into detail. One thing I would say about the fiscal consolidations that we do not mention in this paper is there may have been fiscal consolidations globally, but in the US, we do not discuss in this paper the dramatic increase in entitlement programs that transform themselves into mandatory programs, and that's what's driven deficit spending. And so during these last couple of decades, the projections of the rise in the government debt are they've become embedded. And so that's one point. And on the disinflation, let me get back to that, okay? So let me continue. So the Fed is at the zero lower bound. And its QE1 helps to end the crisis. But then after the economy began recovery, the Fed extended its emergency measures, entered into QE2 and QE3. And QE3 in 2012 was a direct Fed attempt to lower the unemployment rate. But what was so striking is that the QE2 and QE3 boosted bank reserves and the monetary base, but excess reserves effectively sloshed around in the financial system and did not stimulate the economy. That is, nominal GDP growth never accelerated much above 4%, despite all the Fed's efforts. So if we go back to what Bernanke said when he rolled out QE3, the goal was to pump up financial asset prices, increase risk-taking, keep bond yields low, and then with the Woodford-style forward guidance, to all of that would, stimulate the economy. And everything worked, except it really didn't stimulate the economy. So with nominal GDP growth not accelerating, you ended out with a decade of moderate growth and subdued inflation. So one of the critical points we would make is, because the Fed's aggressive stimulus didn't really get put to work in the economy. And the fiscal package of 2009 really didn't have much follow through on it. The economy didn't accelerate. Now, fast forward to the pandemic year of last year, so we had this negative shock that generates a 9% contraction of GDP in one quarter, and immediate and unprecedented fiscal and monetary responses. So just in summary, the CARES Act, $3 trillion and about 13% of GDP in deficit spending. This last December, an additional $9 billion or 4% of GDP. The current legislation will add 1.9 trillion. That's another 9%. So we're talking about over 25% of deficit spending as a percent of GDP. Monetary policy, we know zero rates and massive QE purchases of treasuries and MBS, plus extended lender of last resort facilities, and the Fed's forward guidance that it's going to continue this. And so once again, now when we look at the administration and the Fed, they are prioritizing maximum inclusive employment, and they favor higher inflation. So they're clearly prioritizing employment over inflation, and they want inflation to go higher. So the fiscal transfers to date have clearly supported income and spending, but they've generated excess saving. So let me show this picture. And the left chart shows the surge in the monetary base, reserves plus currency, and very differently than following the financial crisis, a surge in the money stock, and here M2, and you see it in the right-hand chart. It's a lot of it seems to be sitting in commercial bank deposits, earning zero. Now, money's fungible. Some of it probably went into the stock market, et cetera, et cetera. We just don't know. But this issue of excess saving, maybe this puts too much in one chart, but basically, if you look at the saving was about, personal saving was about a little over $1 trillion before the financial crisis. And so the savings rate skyrocketed because people were cautious and businesses were cautious. They couldn't spend because the economy was partly shut down, and the government's fiscal transfers led to a zooming up of savings. So right now, by my estimate, there's saving, there should be an S on that. There's savings above the pre-pandemic level of about $2.25 trillion, or almost 10% of GDP is just sitting there. And so, you know, backing up just a touch, we have just this unprecedented monetary and fiscal stimulus. There's excess saving. The economy is about ready to open up. Now, real GDP should get back to its pre-pandemic level, either by the end of this, first quarter or second quarter, and then grow quickly beyond. But labor markets are lagging GDP. Now, the differences between the pandemic and great financial crisis, they really, to us, highlight the risks of inflation, just the difference between a negative health shock and government shutdowns, which we hope are ending, versus the financial crisis that had significant lingering negative impacts on businesses and banks. Deficit spending this time around is much larger than the great financial crisis deficit spending relative to the contraction of GDP. Monetary policy, not only larger and more open-ended QE, but expanded lender of last resort and Fed forward guidance. And so the surge in M2 that we see now and excess saving did not occur following the great financial crisis. And, you know, back then, the surge in the monetary base generated by the Fed's QEs stayed as excess reserves, and they were not put to work in the economy. We have to see if they will this time. So the question is, will fiscal and monetary policy stimulate and generate excess demand? And a critical issue is, the baseline forecast is you're going to see a surge in demand, but will it be sustained? And here that'll be a critical issue. You know, the banking system's in far better shape now than it was following the great financial crisis. The Fed's new strategic framework favors higher inflation, and they've basically said, they've set a very high bar for preemptive tightening. And you know, there's more deficit spending legislation on the horizon in the form of a massive infrastructure package. So, you know, without going into a lot of detail here, the risks of excessive aggregate demand that would generate higher inflation and higher inflationary expectations, it's definitely a risk to a sustained economic expansion and a risk to financial stability. And of course, then there's the issue of the Fed's credibility and independence. So to date, we've seen some of the precursors of higher operating costs, but it hasn't really hit the consumer price level. And what's really striking here is the Fed is surprisingly sanguine about the inflation outlook, presumably based on the low inflation of the last decade. Now, wrapping up our discussion, you know, obvious clear links between war deficit financing and accommodating central banks generating inflation. There have been episodes of peacetime deficit spending and monetary accommodation have led to higher inflation if excess demand is allowed to persist. And during those episodes, particularly the best example is the US and the UK in the 1965 to 80 period, where you not only had excess demand, you had incomes policies, price controls, and regulations that bottled up the supply side of the economy. And so once again, looking back at the last 10 years, the primary reason why inflation didn't accelerate is there was everything the Fed tried to do to stimulate the economy really didn't work, and you didn't have any sustained rise in excess demand. If the monetary policies and fiscal policies actually work now the way they're supposed to, you know, it may show that the last decade with low inflation was the exception rather than the rule. So our bottom line is, of course, avoid war, you know, be cautious of sustained monetary expansion or monetary accommodation of deficits, avoid fiscal dominance, maintain central bank independence, and keep inflationary expectations well anchored, avoid regulations that are, you know, purport to control inflation, but they really don't work, you know, pursue growth policies, mind how the government spending allocates national resources, and unwind excessive emergency policies following crises. And then finally, heed the lessons of history. And I'll just conclude with the following chart, a market-based measure of inflationary expectations, which has increased before the economy has really reopened. And I'll conclude there.
Thank you very much, Michael and Mickey. We already have some questions coming in. I notice Chris Essek has a question. I want to raise it, Chris.
Sure. Well, thanks for the really interesting presentation. I just wanted to raise the point that isn't indicated in the chat that, well, you oftentimes see quite a high correlation between episodes of high fiscal deficits or very high debt in realized inflation. The link between fiscal deficits and inflation expectations seems less strong. And just to illustrate, in a number of the episodes that you've mentioned, inflation expectations seemed like they were quite well anchored in the 1930s, even if the devaluation in 1933 did prompt a rise in realized inflation. And similarly, in the period after World War II, in the run-up to the Korean War, you saw quite high realized inflation, but inflation expectations remained very well anchored. And in fact, Ike, Graham, and Garber have a nice paper trying to explain this puzzling phenomenon, or perhaps puzzling phenomenon. So, I was just wondering, is the right lesson taking account of these experiences that, well, high debt can certainly pose risk to price stability, to the extent that monetary policy has a high degree of autonomy to use its instruments to achieve its objectives and is not subordinate to the fiscal authority, then we shouldn't be nearly as worried about the risks. And that might be applicable in the current environment.
Yeah, I mean, so I would agree with that. Okay, and I would say, like the episode you looked at, inflation was partly anchored by the fact that we really had not completely left the gold standard in one way or the other. Okay, even in the 30s, it was an intention we would keep some relationship to gold, and then in the post-war, it's the Bretton Woods system, and so that I think that really mattered a lot. But also the Fed in the 50s, the Fed was independent. So I would think that's a reasonably good idea, really reasonably good inference, Chris. Yeah.
Deficits only lead to inflation if people think you're not going to pay them back. So deficits that people think you have a good plan to pay back, no inflation. When deficits come with people's doubt that you have a plan to pay them back, that's when you get inflation.
Okay, thank you. Stephen, do you have a Stephen, and then Bob Hall?
Thanks, guys. A great paper. But I'm in looking at, I'm wondering whether or not, in comparing today to all these prior periods, whether you looked back in all these periods and asked yourself in the 70s, what would have happened if the Fed did exactly what it did and the deficit moved exactly as it did, but at the same time, the Fed raised reserve requirements to 20%. Because I think the fundamental difference between now and then is that through this new way in which the Fed runs policy, it effectively has to pay the banks not to lend in order to grow the liability side of its balance sheet to be able to grow the asset side of its balance sheet. And I go on, and I don't want to waste time hearing myself talk. I want to hear your response to that.
Vicky, why don't you get it?
So Steve, I understand what you're saying, and what I would do is tie into your assessment, why didn't the Fed's zero interest rates and QE work to stimulate the economy in the last decade? Was that due to bottlenecks in the monetary policy transmission mechanism? Did it deter bank lending? IOER and all that. I know Peter Ireland's worked a lot on that. I think a lot of these issues need to be looked at. However, it jumps out at me just the striking similarity between the policy thrusts and the deliberations underlying the policy thrust now, that is, prioritize employment, just like they did in the 1970s, effectively accept higher inflation, and And so I think that's the overriding thing. But I think your point on the capital, the capital standards is valid and worth looking into.
Yeah, because I just think that it's very difficult to get the same type of contribution from the banks and financing inflation if you're holding that. And I guess part two of that is that therefore you push to the capital markets the role of intermediating savings and borrowers, which is not necessarily the most efficient or best place for it to be, but there you have it.
Bob Hall.
Thank you. I've got 3 points. First of all, the Fed was not expansionary in the decade after the crisis in 08 and 09. And the reason is simple. Expansion of the monetary base when reserves pay full market rates is simply not expansionary. It's what makes pushing reserves into banks expansionary is that banks hate to hold reserves when the interest rate on reserves is below the market rate, but they're perfectly happy. Vicky's remarks, I thought, were right on point, that the QE expansions, huge expansions of the monetary base are essentially meaningless. It's just swapping one kind of debt for another at market rates, and that's not where monetary policy traditionally gets its potency. So I think we should, and there's lots of ways of looking at that. You can look at it through a Taylor rule, and thanks to the zero lower bound during that almost the entire period, interest rates were constrained way above the Taylor rule recommendation. And that's just another way of seeing that expanding the monetary base is not an expansionary measure under the conditions under which it was done. If we get some inflation, so that we can lower the reserve rate below market rates, then we'll get a kick from it. And that's, of course, one of the things that Fed's trying to do. Now, the second point is that there's no recent evidence whatsoever about the slope of the Phillips curve over the past decade. And the reason is very simple. The Phillips curve gets its action when the unemployment rate differs from the natural rate, but the natural rate has tracked the actual rate very closely over that whole 10-year period. That came up when Rich Clarida was addressing this group a month or so ago. I showed a picture which demonstrates that. So don't think we learned anything about the slope of the Phillips curve, even though we swept out unemployment running from 10% at its highest to 3.5 at its lowest. All those numbers were very close to the then applicable natural rate. And the final point is that in thinking about expansionary policy today, there's a great deal of confusion between supply and demand. There's still severe restrictions on supply in the US economy. And it's ridiculous to consider expansionary policy against these supply restrictions. It would be much better if all the same effort and maybe some of the money was directed toward removing the restrictions on supply that currently exist. But for now, it seems like an awful lot of the discussion, and especially a lot of what's going through Congress, it's simply Democrats say they always want to spend more and using this as an excuse, but they're not paying attention to the true conditions. For example, the measure that the JOLT survey provides for the duration of vacancies shows that it's extremely hard to find workers these days by the standard of the vacancy survey. So we have a very tight labor market, and we have many tight product markets because of continuing supply restrictions. And that needs to be brought into the story as a primary top level factor that makes the situation in the economy so different today than you'd think from the way policy is being articulated.
You want to comment, Michael or Mickey?
Let me comment. Your first point on the Fed not expansionary after 2008, 2009. I mean, you had this explosion in the monetary base through QE, 1, 2, and 3, but you had a collapse in the money multiplier. That is M2 divided by the base, just collapsed. And I would note that in all of the Fed's intense year and a half self-analysis, it didn't really address why why their attempt to stimulate the economy really resulted in excess reserves that didn't get into the economy. So I'd say that's an important point. On your second point on the Phillips curve, I won't comment on the Phillips curve, but a lot of people have said, oh, the risks of inflation now are really low because you have, a very elastic supply of labor and you have technological innovations. Well, what's striking is if you look back at the 1960s when inflation did rise, that was a decade where you had very strong productivity and a huge surge in the labor force participation rate of women. So the labor supply was very elastic back then, but you did end out with excess demand. And your third point on the confusion about supply and demand, I think the policy environment we're facing now is fiscal policymakers are striving to provide more income support that'll stimulate demand. But then I think the next thing that's going to unfold are increased restrictions and bottlenecks on supply rather than reductions of them.
Okay, so Athanasios has a question. Are you still
yes,
there?
thanks everybody. It's very, very nice work. The question is related to the question that Chris Ersegar asked earlier that also John Cochrane is bringing up. It's and already we shared a different version from Bob Hall. Don't we need also to have the Fed essentially fail to tighten monetary policy when the inflationary threat does show up in the data? So as Bob Hall mentioned, if the Fed were to just follow the Taylor rule going forward, despite the fiscal expansion we currently have, and since we really don't have a fundamental reason to worry about debt sustainability, because I think John Cochrane's point is important, wouldn't that be enough to contain inflation? So shouldn't we bring that up and say, yes, the deficits do create a risk, and if the Fed does not act appropriately, then we're going to have the inflation that actually has been observed after wars in the past. If the Fed does act appropriately, then we don't need to worry about it.
Athanasios, I agree with you, and what we emphasized is, when the Fed moves appropriately to reverse emergency economic conditions and tighten appropriately, then you're not going to have the conditions for higher inflation. You'll dampen inflationary expectations. So I agree with your point. Right now, the Fed is showing no inclination that it will respond appropriately.
So Elena Pastorino.
Thank you, John. Yes, well, thank you for the presentation. I actually have a couple of questions very similar to what Bob has already asked, so I'll be brief. So one comment and question is about the relationship between fiscal interventions and inflationary pressure. So as we all know, some within the Fed system argue that the stimulus packages that is underway is not likely to exert that much of an inflationary pressure, if anything is to be learned by what we saw during the past recessions. And the reason is that both the unemployment and the participation rates are fairly low. So I wanted to understand what your conclusions were from the slides. Is it true that we didn't see such a pressure during the Great Recession? Because after all, the interventions were not very stimulative back then. That's why inflation didn't pick up. And relatedly, in your historical experience, is there a sense in which, like Bob was mentioning, the Phillips curve trade-off has different strengths at different time periods where the participation rate may have been higher or lower, sorry, lower rather than higher? Is that the case then when participation rates are low, there's less of a Phillips curve trade-off to be worrying about? Do you have any evidence of this from past events? Thank you.
I thought the question was about the Depression. Mike, why don't you take that one?
I thought it was about now.
Okay, I guess we'll have to go
Wait,
on.
no, wait, John, let me, look, what we're saying is based on history, the risks of higher inflation seem to the upside. Yet, Elena, you're exactly right. I mean, if you look at the employment to population ratio, the labor force participation ratios, they are low. We know a lot of people who left the labor force are going to come back in. And also, we just don't know whether this expected acceleration in aggregate demand is going to be sustained. So there's a lot of moving parts. And we just have to wait, but we would say the factors seem like they're in place for higher risks of inflation now than in the past, and there does seem to be pockets of labor force tightness in certain sectors, but we just really don't know because the services sector's been largely shut down, and so stay tuned.
Thank you, Mickey. John Cochrane?
So quick comment and a question. Following the discussion on fiscal policy, we're not just spending a lot of money, we're also putting in place unprecedented disincentives for people to get back to work. The marginal tax rate from $40,000 to $100,000 has got to be over 100% by now, and the new stimulus bill makes it worse. But the question I want to ask, so this common story that Great Society and Vietnam War put fiscal stress on, and that was a big thing that caused inflation. But those deficits were nothing compared to what we got now. The debt to GDP ratio in 1972 was the lowest point between World War II and right now. So, why then, not now? Now, I have a theory involving the Bretton Woods mechanism, closed capital markets, but I want to hear your views on why did they not borrow? It seems so obvious when debt is so low and you're running into a balance of payments accounts. If you want gold, borrow the gold. That's what Grover Cleveland did. Just borrowing money to pay for the Vietnam War seems like the answer. So why did they inflate, not borrow? Or was it Bretton Woods? Why then and not now?
See, so John, we've talked about this. I do think I do think it's Bretton Woods. Okay, and their capital controls at this time, and even if the capital controls were sometimes evaded, okay, the capital markets really were very moribund back then, and the kinds of capital movements that were occurring were official transfers. So you didn't have the option of doing that. And you mentioned Grover Cleveland, and yes, there was a balance of payments crisis, and the Treasury's reserves were low, so they set up a syndicate, JP Morgan and Rothschild, to borrow gold from the Europeans and transfer it to the Treasury. So I don't think that was even something they would even have thought of doing back then in the end of the 60s and early 70s.
So your answer is we were having a trade deficit. Today, we can finance that by simply selling Treasury bills abroad or selling US stocks abroad.
Right.
And no problem. But then we're under this Bretton Woods that says the only way to finance a trade deficit is by official gold flows. And it's just a system that doesn't allow trade deficits. So it goes boom. But that does say when it goes boom today, it goes boom much bigger. Where it's kind of like a bank run thing. You're held to a run mechanism, which is supposed to induce discipline. When it doesn't, it explodes sooner, but smaller. If you're an equity finance bank, once you go boom much bigger.
Can I add a few points on fiscal policy and debt. So in 1972, basically, the reason why there weren't high deficits, but inflation was high. I mean, keep in mind, in 1970, 71, and 72, Nixon passed enormous increases in Social Security benefits. So spending went way up. Burns in 1970 didn't hike rates, so the Fed was way too easy. So you had a very strong economy, very strong nominal GDP growth, and wage and price controls that were put on in August of 71. So that kept the lid on inflation until those price controls were lifted, and then inflation jumped up to over 11%. The other point I would make is during that period, you had 17 tax brackets for individuals. And there was aggressive bracket creep because the brackets were not indexed for inflation. And so the elasticity of tax receipts with respect to nominal GDP was very high. So deficits didn't rise that much, whereas now they're all indexed. And so a very different situation, and so I don't think 1972 is a good example, but one of the big differences back then is once inflationary expectations became embedded, and so they didn't go away, they just kind of ratcheted up. Even with the recession in 1970, inflation came down a bit, but inflationary expectations didn't come down that much, and then they really ramped up. Right now, inflationary expectations have been low. They're still low, but they're increasing a bit. But to completely concur with you, I think we will be getting more disincentives and supply constraints on labor going forward. And this gets back to Elena's question, she didn't ask it this way specifically, but could we get persistent inflation pressures even without quote unquote full employment? And I would say yes, definitely, if the Fed keeps doing what it's doing that generates a continued sustained growth in aggregate demand.
But you said something really
So
important.
we got just a few questions.
Sorry.
Sebastian and then Jeff. Sebastian?
Thank you, John. Great paper. I think that there are so many things going on. And there is the question of inflation expectations, risk of inflation. And let me just say on those two, I'm not sure how many of you are familiar with the project that Roberto Rigobon and Alberto Cavallo have at Sloan. Where they look at 1 million data points on online sales, and they've detected huge increases in prices and inflationary pressure. But my question is about something else. Has tolerance towards inflation increased? And what does that exactly mean? I mean, when the Fed says it's 2% average, we really don't know what that means. And I think that there is an unknown sort of inflection point where, I mean, 2.5, it's going to be okay, but what about 6%? And what was tolerance for inflation back during the Vietnam War? And I think that's where we are going to get into trouble. One day the Fed is going to wake up and say, you know what, guys, we really did not mean that 5% or 6% was okay. And God knows what's going to happen then. So what are your views about all of this?
But that's really the $64 question, right? I mean, what is there, when's the Fed going to get worried? I mean, they say they want to raise inflation, have an overshoot, and they say that they can handle it.
But
so
what, 6? Are they going to allow 6?
I don't know. I mean, that's the question everyone's asking. I mean, back then in the 60s, they were worried about inflation, but then when they realized that to deal with inflation, they had to generate a recession, they caved in. So we had this ratchet going on starting in the 60s into the 70s, where the Fed never tightened enough because they were afraid of the political pressure they would get. I see that kind of thing happening again.
So Jeff Lacker, Jeff?
Yeah, great paper. Quick comment. There's a clear explanation of the impotence of quantitative easing in a paper by Uberto Ennis in the 2018 Journal of Monetary Economics. Basically, the banking system with holding a large liquidity buffer for whatever reason, and after the great financial crisis, banking system was required to hold very large liquidity buffers that they could meet with either treasuries, agencies, or reserve balances with the Fed. In that system, once reserves are any reasonable, even a small amount above the former level of excess reserves, which was about 1 or 2 billion, the demand is just flat at the interest rate on excess reserves. And in that situation, basically, as long as reserves are less than the total amount of their liquidity buffer, there's local irrelevance. Local meaning plus or minus a couple of $1 trillion. Last time I looked, reserves were like maybe 40 or 50% of the total liquidity buffers or assets they're holding, maybe less, depending on how you count it. In this range, changes in the central bank's liabilities are going to have no effect until they reach the level in which they are actually their actual existence constrains banks' portfolio choice, which they essentially don't now. And at that point, quantitative easing could have very powerful effects. Given where we are now, it's not obvious how how changes in reserves affect M2. After the great financial crisis, didn't really affect M2 growth. Now, M2 seems to be affected by people's deposits of the stimulus checks they're getting and things like that. And I'd also mention sort of velocity. The implication is velocity is just a residual, it's sort of an arithmetic residual in this sort of picture of the world. And remember, it took just like a 1.5 billion excess reserves under the old system where Fed funds rate was 5%, interest on reserves was 0. And if the New York desk missed by like 2 or 3 billion, they could drive the rate to 0. So basically, the interest rate on excess reserves is pinning down market rates on just about everything else.
Right.
But this is familiar to people.
Jeff, great points. Let me just add on your liquidity buffers following the great financial crisis. The Fed's stress tests and CCAR just put fears into banks, and there were negotiations on how they behind the scenes on how much liquidity banks had to hold, and so this really constrained the supply of credit back then. Now the situation's quite different. Banks are much less impaired, and so let's just see what happens. But they're eager to lend. And your final point on velocity being a residual, this is an area that I think is exceedingly important because so velocity, like if you take M2 velocity, it fell with the closing of the economy. And now you would presume as the economy opens, people get jobs, confidence comes back, you would expect some increase in velocity along with the lower demand for money if interest rates rise.
Yeah, I was thinking about base velocity, so points well taken on him too.
So let's have a question from Tyler Goodspeed. Tyler?
Thanks. Terrific paper. Thanks for the presentation. I know we're running up on time, so I'll be quick. I remember just before the pandemic when we'd had a big $1.5 trillion tax cut followed by 2 big bipartisan budget agreements. There was, of course, a lot of conversation about inflation, the risk of inflation. I remember giving a talk to the Bureau of Labor Statistics at the time, sort of putting on a historian's hat, looking at the differences between the 1960s, latter half of the 1960s, when inflation expectations were already starting to creep up, and fall 2019. And there were a number of differences that I highlighted, but among them, which really stand out in my mind now, was to Bob Hall's point about the labor supply factor. Even though you had the potential female labor supply back in the 60s, that was actually a very gradual transition. So in the meantime, you have 97% labor force participation among prime age males. Whereas in fall 2019, we actually saw that in the wake of a decline, an outright decline in the working age the working age labor force in the United States, in 2017, 2018, 2019, we started to see massive flows from out of the labor force back into the labor force. So by the end of 2019, 3/4 of the flows into employment were folks coming from out of the labor force. So that was a huge difference from the 1960s. And another difference that people have, of course, alluded to is that back then, the composition of the fiscal measures were very stimulative, and we actually saw double-digit inflation in certain healthcare categories in the latter half of the 1960s, whereas the fiscal stimulus in 2018, 2019 was very much productivity enhancing, and we saw the contribution to capital deepening to labor productivity growth really tick up. And then, of course, the third big difference was that we had in the 1960s, we had explicit coordination between fiscal and monetary authorities with the so-called quadriad of the Fed, the Office of Management and Budget, the Treasury, and the Council of Economic Advisors. And that we didn't see at the end of 2019. And as I was reviewing my notes on each of those three big points, there were differences at the end of 2019, and I don't know that those differences still hold, particularly the labor force side factors.
Begin to lose you there at the end, Tyler. So there's one more question that I see, and that's David Papel. David, could you ask that, and then maybe Mickey and Michael can conclude.
Okay, very quickly, when we think about sort of the Fed view, as Jake Powell has really very clearly articulated, is low inflation's the problem now. If we get to where higher inflation becomes the problem, we have the tools to deal with it. When I think about the tools, I think in terms of the Taylor rule, in particular, the Taylor principle, where it gets too high, you raise nominal interest rates more than point for point. But everything we know about that comes from being pretty close to a neutral nominal rate when you started to do that. With the new Fed forward guidance, if they actually follow it, will be above 2% inflation. The federal funds rate will be at the effective lower bound, and there's a long way to go to get there. And that seems very uncharted territory to me in terms of how do we fight inflation when you start from a position of high accommodation.
So,
I mean, I think that's a valid point. Rich Clarida told us at an earlier seminar that, real R star is about 0.05. So a neutral rate is in nominal terms is 2.5, and we seem to be far from there. It's really difficult, even though it seems so obvious, and I think it's even obvious to the Fed, that its current policies are inconsistent with a normal economy. Even though we seem on the verge of that, it's really hard to see what's going to lead the Fed to move to normalize, given the political environment. It's just very, very difficult to see. I hope it happens. It would be the longer they don't normalize, the higher is the risk of financial instability and higher inflationary expectations.
So I think we'll have to end it. We're beyond time. There's a few questions, but we'll send those around to Mickey and Michael. I can answer them. But this is terrific. Thank you so much. Thanks for all the good questions and the great answers. See you next time.
Thanks a lot.